In this video, we're going to have a look at an example on the taxation of lump sum benefits. Okay, so let's have a look at the example. On the 31st of January, during the current year of assessment, Mr. T retires from the DEF pension fund. He receives a lump sum of 1.5 million rand. On the 28th of February of the previous year of assessment, he had an unclaimed balance of contributions of 30,000 rand, and during the current year of assessment, 15,000 rands worth of contributions were disallowed in terms of Section 11F. He received a withdrawal benefit of 250,000 rand from the RST Provident Fund on the 31st of January 2010, and tax of 40,950 rand was paid on that benefit. We want you to calculate the tax paid on the current lump sum benefit. Okay, so why don't you stop the video here and see if you can do that from what you've learned from the theory. Let's see if you would be able to work out, and then you can start the video again and see how you did. Okay, so welcome back. If you stopped the video, I hope you did, because it's good to do it yourself and to test how much you understand. So let's have a look at our calculations. We have two columns, one for the lump sum and one for the taxable income. Remember, you would need to add columns if there were more than one type of lump sum being paid during the current year of assessment, and at the most you would need two columns for lump sums, one for retirement including severance benefits and the other one for withdrawal benefit. Okay, so in the current question, we're going to start off with gross income, and in the gross income, we're going to show the lump sum benefit of 1.5 million rand. Now remember, it's the net amount that's included, so we are able to take off the deductions, and in this case, the first deduction is the unclaimed balance of contributions of 30,000 rand. The question also tells us that there was an amount disallowed in the current year of assessment, but this is not deductible as a deduction in terms of paragraph 5 or paragraph 6, so just show it as a dash, and which gives us a lump sum, a net amount of the lump sum of 1,470,000 rand. Okay, now remember, in a question you would then carry on and deduct your exempt income, your deductions, to get to a taxable income, all in this taxable income column. And also remember that once you have a look at the information on the lump sum, that we can head this column retirement lump sums, because it tells us in the question that he retired from the fund. Okay, so now what you're going to do is you're going to add the lump sum to your taxable income that you calculate, and you're going to show the total taxable income for the current year of assessment. Okay, let's just go back there. Sorry, I pressed forward too fast. So at the end of your calculation, you would have your normal taxable income, add your lump sum, and that would give you the total taxable income for this year. Okay, so let's have a look now at how we would calculate tax. So first of all, you would calculate normal tax on your taxable income, excluding the lump sum. You would minus the applicable rebates, you would minus the applicable medical tax credits and additional tax medical expenses in terms of Section 6A and Section 6B, and that to that you would add the tax on the lump sum. Okay, so we've got the information for that. So in this case, we can calculate the tax on the lump sum. But remember, it's a cumulative tax, so we need to take the current lump sum, which we've calculated at 1,470,000 rand, and to that we need to add any retirement lump sums, any withdrawal lump sums, or any severance benefits after the applicable dates. So in this case, there was a withdrawal benefit, and it was after the 1st of March 2009. It was actually during 2010, and so we can add the previous lump sum of 250,000 Rand. Remember, we add all previous lump sums that are after those specific dates. So in this case, the cumulative lump sum is 1,720,000 Rand, and we're going to need to take that to the applicable table for the current year of assessment. Now remember, it's very important which table you use, because if we have a look at the withdrawal benefit table, we'll see that only the first 25,000 Rand has a 0% rate of tax. Now for this example, it's not a withdrawal benefit. The taxpayer retired, Mr. T retired from the fund, so we're not going to use the withdrawal table. We're going to use the retirement and death benefits or severance benefit tables. And you'll see there that the first 500,000 Rand is exempt from tax or taxed at 0%. So if we get back to our example, we've got in this example now a cumulative lump sum of 1,720,000 Rand. We're going to use the retirement tables, which means that we minus 1,050,000 Rand from the 1,720,000. That gets taxed at 36%, and to that we add 130,500 Rand according to the table, and that gives us a total of 371,700 Rand. But that's on the cumulative lump sum amount. So we need to then minus the notional tax. Now remember, we look at the previous lump sums, the 250,000, and we use the table that's applicable to the current lump sum that was paid out. So in this case, the current lump sum was a retirement lump sum, and we'll see that 250,000 is less than 500,000, so it's not subject to tax according to the retirement tables. You can ignore the amount of tax that was given to you in the question, because the Act says to us that we must calculate a notional tax using the current lump sums applicable tables. So there was no tax on the 250,000, so we can't minus anything from the 371,700, which means that that is the tax on the current lump sum, and we'll add that to the normal tax less the rebates and the medical tax credits, and that will give us a total tax liability for this taxpayer for the current year of assessment.